Housing Wire doesn't think the housing market is going to crash. Logan Motashami says that the rate and forecast of the 2024 that our housing market is not going to crash. Now let's go into why he thinks it's not going to crash, and I would love to hear your thoughts as I'm kind of going through this.
It's just right now we're a carbon copy of what happened at the end of last year, and we just go with it. If that's still the case, that's what prices are going to do.
He breaks down the 10-year yield and the mortgage rates and how those affect each other. So remember that the 10-year yield on the treasury bonds, that's going to affect how the mortgage rates go. If the treasury yield starts dropping, then the interest rates will drop. Right now, what he's saying is in the year for 2024, the 10-year range will be similar as 2023 with a few different variables to watch. Now, what I appreciate about this article is as we go through it, he's not saying like, hey, this is tried and true. What he's saying is, hey, this is what I think is going to happen. But if something else happens, which you're going to have to stay to the end to see, if something else happens, then this will happen. And so I really appreciate that about his article here. But what he's saying is for 2024, the 10-year range will be similar as 2023 with a couple different variables. The 10-year range, what he thinks the 10-year yield range is going to be is between 4.25 and 3.21. And that means that the interest rate range is going to be anywhere from 7.25 to 5.75, which we've seen right now. Interest rates right now are floating at that 6.1, 6.4%, depending on the lender that you're talking to. But what he's saying is a key level to watch for the 10-year yield is 3.375. If we were to go below this level, last year, labor would need to break. So and he borrowed a phrase from Gandalf, and he says, "You shall not pass." The 10-year shall not pass in the level of 2023, and I don't believe it did. If the labor market and the economy data gets weaker, we can break through that Gandalf line, which means that we will see the yield drop to 2.72 on the 10-year yield in 2024. And this would mean sub 5% mortgages if that spread gets bigger. And so in his mind, this is a win for the housing market. If the spread is still bad and mortgage rates will be between 5 and 6 and the 10-year gets to 4.25, the economy has again outperformed. So let me just break this down, what he's saying. So he's saying is if we see the yield drop to 2.72, then that is a huge win for the housing market because interest rates will now drop below 5%. And I do believe that if interest rates drop below 5%, then and we're not talking about the Fed fund, we're talking about the 30-year mortgage interest rate. If it drops below 5%, then all of a sudden mortgages are going to get cheap again. Remember, every 1% of increase is a 10% loss in buying power, and the reverse is true as well. So as it goes from 7 to 6, then you just increased your buying power by 10%. From 6 to 5, again, another 10% increase. He's saying, hey, it's going to be a huge win. If the mortgage rates stay between 5 and 10, that means that the economy has outperformed again, and jobless claims have fallen. But as many of you guys have voiced to us, and as we know, the only reason why joblessness claims are falling is because we have to take on multiple jobs just to make our ends meet, just to pay for our groceries, to go out to dinner maybe once in a while, to pay our mortgage. And so that's really why the jobless has fallen. But we know that big tech sectors are coming out in layoffs. For instance, Google just said that they're laying off 30,000 people from their workforce, which is a huge blow to people that are working there. He goes on further and he says, okay, let's talk mortgage rates. Let's talk mortgage rates on 10 years. He thinks that the 10-year yield and the mortgage rates will get better in 2024. He thinks that the interest rates are going to drop from 6.25% to 1% by this same time next year. Do you think we're going to see sub 5% interest rates in the year 2024? And if we do, what do you think is going to do? Is that going to help us or is that going to hurt us? Now, he thinks that home prices are going to stay constant. So home prices, they're going to stay constant in 2024. He also thinks that it's going to grow. It's going to grow, but he thinks they're going to stay in the single digits. He says, however, the home prices could grow faster if not as many people are putting their houses on the market and interest rates continue to drop. He thinks that the low supply and the drop of interest rates is going to cause the home prices to grow even faster than single digits if we don't see some kind of surge of inventory. Now, he says, now, what would it cause for home prices to decline? Now, many of you guys know this. What would cause home prices to decline? Well, if there was a surge of stress inventory and mortgage rates didn't go low enough to handle new supply coming on the market. He's saying if we don't see mortgage rates drop between anywhere from 3.75 to 4.75 as most of the decade has seen, then we will only see a slight increase of stress inventory. For example, in 2008, 2011, new listing data ran between 250,000 to 400,000 each week, with a peak of 370,000 to 400,000 at the peak season. Right now, new listings are sitting right around 90,000 every single week from 2021 to 2023, which has stressed new listings and created our supply to come down. Even here in the Boise Metro, as our supply has dropped, so too has buyer demand, which has caused prices to drop. Remember, if demand is dropping faster than supply, then you will see home prices decline in your area. He brings up an important fact that we can't overlook that will happen in 2023. He's saying when we saw mortgage rates drop from 7.375 to 6% in 2023, we saw a jump in increase of existing home sales. So this is not resale. This is this is not new construction. This is resale. And he saw that there was a jump from 4 million to 4.55 million. What he's saying is we need lower rates to get consistent sales growth to have 1 or 2 month existing sales price. Now, I don't think we need to have mortgage rates drop. I think we need to have affordability come back to the equilibrium. To me, if we're seeing sales growth, we're actually not seeing affordability grow, especially here in the Boise Metro. So this is where I differ with him. I don't think we need sales growth. I think we need affordability growth, because so many of you guys have been waiting to get a house, but you can't afford it because the mortgage rates and the home prices are out of whack. And I think what we need to see, and what I want to see, is affordability to come back to equilibrium. The average single family or single income home can go out and buy a house. To me, I think that is a win, not having sales growth, but having you guys who have been waiting and patiently saving and working on your credit so that when the time comes, you can jump on a house and it's affordable and you're not struggling to make ends meet. That to me is a win, not a steady growth in home sales. As you can see, home sales price has been on a downward decline since and according to his data, is the national home price have been dropping from June of 23 and have steadily been falling since November of 23. He also shows in this graph that inventory, although it was increasing, has started to decrease again. And he thinks that maybe with these lower interest rates, these sellers that feel like they're stuck will start seeing. But remember, he says if we see a surge in stressed sales and buyer demand does not increase with that surge, then we're going to see home prices drop even more significantly. So going back to this article, he says new home sales, as long as mortgage rates get lower, builders can sell because they can lower mortgage rates even more than the existing home sales market. And again, how do they do that? Well, they team up and they call their buddy, hey, Mr. Lender, can you team up with me? I know you're struggling for business. I need to move this inventory. How about you give up $5,000? I'll give up $5,000 and we'll get somebody in at a lower interest rate so I can move this inventory, whether it be a 3-2-1 buy down, a 2-1 buy down, adjustable rate mortgage, or they're just buying it down for long term. But this is why new homes are moving more than resale, because resale, they're limited on what they can move their inventory for. They're limited on what they can sell their house for. Where new home builders, they got a lot of inventory, and so they can incentivize a lender to say, hey, how about you kick the buyer some money, I'll kick the buyer some money so I can move inventory and you can get paid because you're struggling on making ends meet as well. He says they have about 106 that haven't even started construction yet. 106,000 homes that are going to be started, and only 78 new homes have been completed and are ready to sell. And so they are managing their low supply. But I think ultimately also what's happening here is that builders are building houses and they're not putting it on the market yet. They aren't putting it on the market until maybe they're 30 days from finishing, 60 days from finishing, or some of them are waiting until maybe they have some more of their inventory or more inventory in the subdivision sold, and then they create this scarcity thing. It is not uncommon if you go to a new construction site, you call one of the new builders or your agent that you're working with and you say, hey, I like this, but I want something else. And they call the builder's agent and say, hey, listen, my client would be interested in your house. I'm like, well, we actually have this one and this one. We don't have pricing yet for it, but it's going to be coming on the market. Or we have 5 other houses that are going to be hitting the market. Maybe your client would like this. So it's not uncommon that the builder will only list a couple houses, and you can go and find some of that, what they call a shadow inventory, by just doing a little bit of research or making a couple phone calls.